SEBI brings transparency to mutual funds. The Securities and Exchange Board of India (SEBI) recently announced an important change in how mutual funds in India present their performance to investors. In a new circular, SEBI directed mutual fund companies to disclose a metric called the information ratio (R) for all equity-oriented schemes. This measure will be updated daily on mutual fund websites and will also be available in machine-readable formats on the Association of Mutual Funds in India (AMFI) website. But what does this mean, and why is it so important? Let's break it down. To understand the significance of this move, we first need to explain what the information ratio is and why SEBI wants mutual funds to disclose it. At its core, R is a simple financial metric that helps investors evaluate a mutual fund's performance relative to its benchmark. What sets R apart from other metrics is that it considers the crucial element of risk. And beyond just numbers, R is also looked at as a judgment metric for a mutual fund manager's skill. It helps investors figure out how consistently and effectively a fund manager can beat the benchmark while managing the risk that the fund undertakes. Think of it this way: a fund manager can have 1 or 2 good years, but that tells you nothing about their skills. In a bull market, it's often hard to lose money even if you try. But fund manager performance should be measured over long periods of time, and the information ratio is one helpful metric in evaluating the skill vs luck of fund managers. So, in straightforward terms, R shows how much extra return a mutual fund generates for every unit of additional risk it takes compared to its benchmark index. If this still feels complicated, let's use an example to simplify it. Imagine 2 mutual fund managers, let's call them Manager A and Manager B. Manager A generates a 30% return in a year, while Manager B delivers a 40% return. At first glance, Manager B seems like the better performer. But if Manager A takes on much less risk to achieve that 30%, while Manager B takes significantly more risk to achieve 40%, the story immediately changes. And this is why R matters. If you judge a fund only by its past returns, you may not get the full picture of how it will do in the future. During stable or bull markets, higher risk funds often do well because momentum is on their side. But, in turbulent times, those same funds can get hit the hardest. R not only looks at how much return a fund delivers but also talks about how efficiently those returns are generated, given the risks involved. A higher R means a fund is better at managing this balance and offers more value for every unit of risk you take with your money. Of course, for a long time, mutual funds have disclosed metrics like beta, alpha, and Sharpe ratio, etc., and each of them serves a specific purpose. For example, Sharpe ratio tells us how much return a fund generates for each unit of risk it takes. But the thing is, none of these metrics capture both excess returns and performance consistency as effectively as the R does. So, by mandating daily disclosure of this metric, SEBI aims to give investors a clearer and more holistic view of a mutual fund's performance. In India, this is particularly important. That's because investors usually buy mutual funds in our country almost solely based on past returns. And as you've probably realized by now, while returns are a key part of the equation, they don't tell the full story. A fund delivering high returns but taking on excessive risk might not be the best choice for long-term investing, and this is exactly what the R addresses. So the next time you are evaluating active mutual funds to invest in, this information ratio is a useful metric to consider. But all that said, while SEBI's mandate is a great step forward, the bigger challenge will be in making this metric a standard part of how investors evaluate mutual funds. If people continue to focus only on high returns without considering the risks involved, the purpose of metrics like the R will be lost. Tidbits. Perplexity AI has made a bold $50 billion bid to merge with TikTok's US operations, aiming to combine TikTok's massive user base with its AI expertise. The move could reshape digital advertising and alleviate TikTok's regulatory challenges, positioning Perplexity AI as a tech sector disruptor. The CCI fined Goldman Sachs 40 lakh rupees for failing to notify its 1070 crore rupees Biocon Biologics investment under regulatory norms. Strategic rights tied to the investment triggered mandatory disclosure, underscoring the importance of compliance in financial transactions. MRF is driving growth with EV-specific tires for major OEMs and contributions to India's defense projects like Sukhoi jets and Tejas aircraft. With export revenue surging 20-25%, MRF aims to increase its global share while investing heavily in manufacturing to meet demand. Thank you for watching. Do share this with your friends and make them as smart as you are. Winking face. Join the discussion on today's edition here.